So Uber's early investors were able to turn $1 million into $2 billion. A lot of us don't know that story because the majority of us didn't have access to pre-IPO stages in companies. We only know the IPO point, when the company goes public, and everything after that, really. When Uber went public in 2019, it was going for around $45 a share. Most people looked at that number and decided whether to buy in or not, because this was a new stock to them. It only just landed in public marketplaces, whether it be on your app or however you trade, and that was the first time you had access to it. What they didn't see is the decade of value creation that happened long before they went public, before that price ever existed. In 2011, a valuation of around $60 million. When Uber finally did go public, they were valued at around $82 billion. That's a far cry from the $60 million valuation that Benchmark Capital got in on. That's before they ever listed. Early investors who were able to get in during the private rounds were getting a company valued below $30 billion. By the time they IPO'd, we were looking at a valuation of $68 billion. The pattern holds across enough companies for it to at least be interesting, and we can see that compounding often happens while the company is still private. This is by no means investment advice. Companies fail. Private investments carry real risk, much like public ones, but there's also limited liquidity. The structure of value creation in high growth companies is still worth understanding if you want to take investing seriously. The question retail investors have been asking for years, though, was not the risk. It was much more to do with the access and how were they able to get in on pre-IPO opportunities as well. Thanks to apps like Wealth now, we have access to these pre-IPO opportunities and can invest in these companies that we believe in before they go public.